Many of us like to fill our closets with the latest trends, but when it comes to investing, sticking with the classics, like stocks with the potential for dividend growth, may be a better approach. Hello and welcome to Edward Jones Perspective. I'm Casey Joyce. Today we're talking with Edward Jones investment strategist Kate Warren. Kate, tell us why it's important to consider dividend-paying stocks.
Casey, investors often focus on potential stock price increases, but may not consider dividends or the potential for dividend growth as a key component of total return. But when you study the track record, you'll see that dividend-paying stocks have historically outperformed those that don't pay dividends. Since 1972, dividend-paying stocks returned an average of 8.8% a year, compared with just 1.7% for those that didn't pay dividends. And in that same time period, those that initiated or increased their dividends annually had even better results. They returned an average of 9.6% per year. Of course, the past is not a guarantee of future performance, but dividend-paying stocks have persistently outperformed over many time periods in the past.
Dividends clearly are important for many investors, but are all dividend-paying stocks equally attractive?
No. As with any investment, it's important to choose quality companies. In today's environment, many investors are looking for more income, attracting some to stocks offering the highest dividend yields. While dividend yield is an important component of a stock's total return, focusing on today's highest yielding stocks can be like buying the latest fashion trends. What may be hot today might not necessarily be appropriate tomorrow.
Why is that so?
Stocks that offer high yields today may offer less dividend growth and even a higher risk of dividend cuts down the road. In fact, since 1972, the stocks in the S&P 500 with the highest dividend yields have performed worse than stocks that didn't pay dividends at all. Many companies had these high yields because their stock prices had fallen due to financial difficulties, not because their dividends had grown. They frequently cut their dividends, and some even went bankrupt. Remember that a high yield frequently means high risk.
So are there any opportunities for investors looking for rising dividends?
Yes, a key characteristic to look for is a track record of dividend growth. And recently, more companies have been increasing their dividends rather than reducing them. The payout ratio for these companies is near its lowest level in 86 years. A low payout ratio indicates the ability to continue paying and possibly increase dividends in the future. We can't predict the future, but in our view, these indicators are good news for future dividend growth.
Aren't the lower tax rates on dividends scheduled to expire at the end of the year?
Yes, qualified dividends have been taxed at a rate of 15% or less since 2003, and those lower rates are scheduled to expire at the end of 2012. However, we think dividend-paying stocks still make sense for three reasons. First, no one can predict what will happen to tax policy, and even scheduled tax changes don't always occur if Congress decides otherwise. Second, dividends have endured. Since 1972, there have been 16 different dividend tax regimes, and companies continue to pay and raise dividends through all of them. Finally, dividends can provide income today and tomorrow. We don't suggest you own only stocks with a track record of increasing their dividends, but they can play an important part in helping your portfolio grow over time. The latest trends can be exciting, dividends can seem boring, but when you think about your financial future, we think many investors may find that dividends, and especially the potential for dividend growth, are a classic style that can form the foundation of a stock portfolio.
Thanks, Kate. For more information about how dividend-paying stocks may make sense for you, talk to your Edward Jones financial advisor.